Hello, everyone. I hope everyone is doing good and listening me clearly. So please, guys, do let me know. Are you guys listening me clearly? Just like write okay in the chat box if you can listen me clearly. Thank you so much. Okay, brilliant. So, guys, this is day 4 for this practice to pass session for June 2022. And today's agenda is we are going to quickly revise and we are going to solve related questions on classification into debt and equity, share appreciation rights in IFRS 2, which is obviously cash settled share based payments, then the impact on ratios. What would be the impact of classification of debt and equity? What would be the impact of appreciations? And in the same way, we will be talking about IFRS 15, in which we will be talking about series of goods or services. What does it mean? Obviously, we'll be talking about it in a while. Then we will be talking about IFRS 5, which is initial classification and related measurement. So the next area would be initial classification and measurement. So these are the topics that we need to revise and we have to solve related questions. On the other hand, the last topic would be sale and lease back in IFRS 16, and we will be solving a question on sale and lease back as well. So let's understand, guys, what is first topic that we need to revise. It is the classification into debt and equity. A detailed discussion has already been done in September 21 practice to pass session in day 1. So in day 1, I have discussed the classification into debt and equity in detail. After watching the day 1 video, you will be you will have sufficient knowledge to classify any type of debt and equity. So the detailed discussion is there, but right now we are going to revise the related uh, concepts that are going to help us to solve the upcoming question. So what is in this classification into debt and equity? Guys, whenever whenever you raise some funds, some cash, whenever you need to classify that into debt and equity. So it means if I am issuing certain shares and receiving cash, if I'm issuing certain bonds and I'm receiving cash, even if I'm issuing certain coins, and against these shares, bonds, coins, I'm receiving some cash. So what should be the journal entry, guys? Obviously, the journal entry would be that you are receiving cash by issuing these shares, bonds, coins. So debit would be cash or bank. But what should be a credit entry? What should be the corresponding credit entry? The credit entry could be equity if the amount is from owners. It could be a liability. It could be a liability. It could be a liabilities. And the last thing could be, it could be a revenue as well. So whenever we have some inflow, we need to classify, we need to, we need to classify the cash received into equity or liability or revenue. Obviously, revenue will be recognized when we earned income, when we are selling goods, services. If we are selling goods or services, then we will be recognizing certain amount of revenue, income. Otherwise, the cash received by issuing shares, bonds, coins will be treated as either liability or equity. And we have IS 32, which govern this classification into debt and equity. Now, how we can classify any cash received into debt and equity? So a very simple concept is if you have obligation to pay, then you should treat this amount received as a liability. If you have obligation to pay either interest or principal, if there is any obligation that you are bound to pay, then it means it should be a liability. But if there is no obligation to pay and you can avoid that obligation, you can avoid the outflow of cash, no obligation, we can avoid payment, can be avoided when payment can be avoided. What does it mean? It means that no one can ask you to pay. If no one can ask you to pay, you can avoid the payment by somehow, then it means it would be equity. So if you have obligation to pay principal, the amount we received at the time of issue, if you have obligation to pay interest, that the return that you have to pay, or you have obligation to pay dividends, then we will be going to treat this as a liability. Otherwise, it would be an equity. Now, this is a basic concept that you need to solve the question that we are going to solve in a while. So detailed discussion would be in September practice to pass day 1 video, so you can watch that video. Now, guys, let's move towards the question, and now we are going to understand what we are actually talking about. So this is the question that we are going to solve. This is a question on a mixed question on IS 32 classification. Then again, there will be share-based payment, and then the impact on different ratios. So this is the question. So let's see what is the requirement of this question. So Amster is the question. The source is BPP exam kit. Although it is a past paper question, but I picked this question from BPP exam kit. So look, what is the requirement? Discuss whether the accounting treatment of the above transaction is acceptable. So first you need to tell them whether the accounting treatment is acceptable or not. So in your answer, there must be one line in which you have to write that whether the accounting treatment is acceptable or not. So if the treatment is not acceptable, so you should write that this treatment is not acceptable under the standards. So what is the correct treatment? Obviously, you have to write the correct accounting treatment as well. According to the international accounting standards, including any adjustments which is required to the capitalization table. So the second requirement is you need to tell the effect on the capitalization table. What is capitalization table? This is the table which is given here. So capitalization table. So you need to talk about the impact on these values. Maybe you have to reclassify certain liabilities into equity or equity into liabilities. So there would be some transactions that you need to adjust. Then guys, there are two requirements right now. You have to tell whether the accounting treatment is acceptable or not. Then you have to tell what would be the impact on capitalization table. And then third, there is a third requirement as well. You have to tell the effect on gearing and return on capital employed. So you have to tell the effect. So there are three requirements hidden in one requirement. So the most important thing would be divide the requirement. So you need to talk about three things, guys. Now, if you have to talk about three things, now what is next? This is important. So the next is, let's start a question. So the first paragraph and the second paragraph is on IS 32 classification into debt and equity. So we are going to solve it together. So listen carefully. What is here? Amster has issued two class of preference shares. So there are two classes of Amster shares. The first class was issued at fair value 50 million. So the amount is 50 million on 30th November X7, which is actually your year end. The share gives the holder the right. So this is important. These shares give the holder the right to a fixed cumulative cash dividend of 8% per annum of the issue price for each preference share. It means you have to pay 8% of 50 million to the holders. Holder has the right that you have to pay 8% to them. So if you have obligation to pay 8%, it seems that it is a liability. It seems, till now, it seems that it is a liability, but let's see what is written in the next lines. The company may pay all, this is important, the company may pay all, part, or none of the dividends in respect of each preference share. So this is really important, that the company can decide whether they want to pay all the dividend. All the dividend means the 50 is the total amount, 50 into 8% will give us 4 million. So if they want to pay 4 million, they can pay, they may pay. And if they don't want to pay 4 million, they want to pay 3 million, they want to pay 4 million, they want to pay 1 million, they can pay a part payment as well. And even they may pay none of the dividends. So it seems that there is no obligation. So let's see what is next in the question. If the company does not pay the dividend after 6 months from the due date, if the company does not pay the dividend after 6 months from the due date, what is due date? So every year you have to pay an interest. Every year you have to pay an interest. Every year. So every year you have to pay an interest. So if you are not paying any interest, after 6 months of due date, means after year end, what you need to do? Again, after the 6 months from the year end, you have to pay. What you have to pay? Due date, then the unpaid amount carries interest at twice the prescribed rate, subject to the approval of management committee. Subject to the approval of management committee means if company wants to pay a dividend, then they can pay 16% of dividend, twice interest at twice the prescribed rate. Interest at twice the prescribed rate. What does it mean? It means if the total amount at the end of year one would be 8 million, 4 million, 8%, 4 million, you have to pay 4 million. But after 6 months, the interest will be 16%. Interest will increase. So it seems that maybe we have a liability, because if we are not paying, we have to pay extra interest on the unpaid amounts as well. So it seems it is a liability. But the most important line is subject to the approval of management committee. It means it's a management committee who will decide whether to pay or not. Means if you don't want to pay this a double interest, then it's okay. You don't need to pay. So it means if it is at discretion of management committee, if it is at the will of management committee, then it means there is no obligation at all. The preference shares can be redeemed, but only, this is important again, the preference shares can be redeemed, means this 50 million you have to redeem, you have to pay it back, but only on the approval of management committee. So what do you think, guys? Is it a liability or is it a equity? So just give me a final verdict. Is it a liability or is it a equity? So what would you write by if what would you write if you want to conclude that this is a liability? Yes. So yes, you are right. The first thing that you are going to write is really that we don't have any obligation. But this is very generic thing that you are saying that we don't have obligation, so this is equity. So you have to prove to the examiner that why this is not, why there is no obligation. So yes, everyone is right. So the answer is this. This is the answer. Answer is, as no obligation, so it should be a liability. No obligation, so it should be equity. So this is the answer. Everyone know this. But the correct answer, the appropriate answer, the better answer would be you have to prove that why we don't have obligation. So you need to give them no obligation. Why you are saying that no obligation? How can you say that there is no obligation? You know, the philosophy is why and how. So you have to prove why and how you can say that there is no obligation. How can you say that? Please just let me know, how can you say that there is no obligation? Exactly. So can we say that both interest and principal repayment is at discretion of at approval of management committee? So this is the line, at approval of management committee. No one can ask management to pay this amount. Management committee. No one can ask management to pay this amount. So it means this is an equity. So it should be treated as equity. Now what is next now? Yes. Brilliant. The second class of preference shares was issued at a fair value of 25 million. So this is 25 million, guys. This is 25 million. So this is 25 million. What is this? What is in this 25 million? So let's understand. So what is next? Okay. Issued at a fair value of 25 million and is a non-redeemable preference shares. It means you don't have to pay back this amount. The share has a discretionary means at the choice of at choice at choice of So the share has a discretionary annual dividend which is capped at a maximum amount. So the dividend is at discretion of company, at the choice of company, and you there is a cap at the maximum amount. So it means you have to there is a limit what maximum that a company can pay. So there is a limit capped by at a maximum amount means. If the dividend is not paid, then no dividend is payable to ordinary shareholders. But there is a condition that if you will not pay dividend to these preference shares, then you can't pay dividend to ordinary shareholders. And we know that ordinary dividend to ordinary shareholders is again at choice of company. This is again at choice of at discretion of company. So it means it is very simple for a company to avoid this payment. How they can avoid this payment? By not paying dividend to ordinary shareholders. So if they decide that we are not going to pay dividend to the ordinary shareholders, then they don't need to pay dividend or interest to these preference shares. It means they can easily avoid it. So if a payment it can be avoided and no obligation for principal and no obligation for principal and no obligation for interest, what does it mean? No obligation, guys, for interest, no obligation for dividend, no obligation for principal. Principal means the initial amount that we receive, which is 25 million. So it is again a equity because we don't have any obligation. So guys, again, you need to prove why you are saying that this is equity. So it is very simple again. So how this is simple? Look, this is non-redeemable preference shares. Non-redeemable preference shares, discretionary annual dividends, discretionary dividend, and the condition which is attached is again at the choice of company. Company can easily avoid the payment. So this is equity. Now, guys, they are saying Amster is currently showing both classes of preference share as liabilities. So the treatment according to the Amster is they have treated them as a liability. So is it acceptable or not? So you should write a line that this is not acceptable. So Amster is currently showing both classes of preference share as liabilities, which is not acceptable because both of these preference shares should be classified as equity rather than liability. Why we are saying that preference shares are liabilities, we have already discussed. Why we are saying that preference shares are not liability, they are equity, we have already discussed this. So guys, this is what you need to write. So okay, now we have just answered one part of the question, guys. There are three parts. So this is something that you need to take care in exam. You have to divide the requirement into sub parts and you have to answer every part. Okay. So what is next now? So we have talked whether this is acceptable or not. Now the second requirement was you need to give them adjustments to the capitalization table. So what adjustment required, guys? So I'm waiting for your answers. Please write an answer. What should be the, so just tell me what should be the adjustment in capitalization table. Brilliant. Yes, you are right. So this is something that you need to do, and that is you need to deduct it from liabilities. So we have to deduct this from liability. Yes, you are right. And we need to add this. So now we need to add this in equity. So we are going to do this. So let's see, guys. So I'm going to deduct this from long-term liabilities. Okay, here is the cumulative liability. So we need to deduct this from preference shares liability, and we need to add it to equity. We have shareholders equity, so this will increase. Now I just want you guys to write what would be the impact on gearing ratio, the look, and what would be the impact on return on capital employed. What would be the impact on capital employed? What would be the return on capital employed? So I'm just waiting, guys. Just give me impact on two ratios. So what is the gearing ratio? Let me explain. Gearing ratio is long-term liabilities divided by long-term liability plus equity. So this is gearing ratio. What is next? What is next, guys? The next is capital employed, which is P profit before interest and tax, PBIT, profit before interest and tax, divided by equity plus long-term liability. So you need to tell them the effect on both ratios. So please give me the effect on both ratios, guys. So I'm waiting. Is that okay, guys? Yes. Yes, guys. The long-term liabilities. So you are actually reducing long-term liabilities. You are reducing long-term liabilities. So numerator is decreasing and you are increasing equity. You are increasing equity. So it will obviously decrease gearing. So the gearing ratio will decrease. Even you can calculate, although the examiner didn't ask you to calculate gearing ratio, but you can calculate before adjustment and after adjustment. Like what is before adjustment gearing ratio, what is after, you can do that and you can give them the exact impact. So it will decrease gearing ratio. The gearing ratio will definitely decrease. And on the other hand, if the thing, initially the preference shares were classified as long-term liabilities, now you are actually reclassifying them to equity. So the denominator will remain same. Equity plus long-term liability. It means the denominator will remain same and profit before interest and tax will also remain same because this is before interest. So liabilities interest will have no effect on PBIT. If you have classified something in a liability, it will not affect profit before interest and tax. If you have classified something in equity, it will not affect profit before interest. So there will be no impact on gearing. Someone asking me that what if we write long-term liability to equity? The impact would be same, why? Even then, it will decrease because liability is decreasing, equity is increasing. Ultimately, the impact would be same. But if they are not talking about any type of gearing, so usually we call this ratio as a gearing ratio. We call this ratio as a debt equity ratio. This is a common thing. We call it the debt equity ratio, and this is a gearing ratio, long-term liability divided by long-term plus equity. But yes, you can write this that this is also reflects gearing, but you should use, if this is not mentioned, what should be the formula for gearing, then you should use this formula. Now, guys, so this was the impact. So again, a good question on interpretation along with other standards. The standard here was IS 32. So we have covered all the aspects, all the requirements in question. Now, guys, I just want you guys to write, I just want everyone to talk about that if we need to take maximum marks, how much do we need to write? How much do we need to write? So now this is something that I just want to ask, okay? So what do you think here, guys? What you should be writing to answer this part? Obviously, we have already talked about that we need to write this, that why we are saying this is equity, why we are saying here, we need to tell them why we are saying that this is the liability. Obviously, we should be writing this thing. Then if you want, if you have some time, then you can write the classification, basic classification criteria. Basic classification criteria. And which is you need to classify. If there is no obligation, look, if there is no obligation to pay, then it means it is a liability. If there is obligation to pay, then it means an equity. At least you can write this criteria. There is one more criteria, which is substance over form. You can write the substance over form as well, but the substance over form the substance over form. It means it's the substance of preference share which will decide whether it's equity or liability. It's not the legal status of the preference shares. Usually under law, preference shares are equity, but we don't follow law when we classify financial instruments, issue of shares, issue of loan notes into liability and equity. So these are the basic criteria. So you can quickly write that the classification should be on the basis of classification criteria, which is if we need to meet, we need to watch the substance over form, we need to follow substance over form, and the other one is we need to follow the definitions of equity and liability. And then you can write the reasoning why you are saying they are incorrect, why you are saying that it should be an equity. Then by writing this, then you can adjust and then you can talk about the other things, and that's the final answer. Examiner's answer are always for is always right, like 150 160%, and you have to take just 60 to 70%. You have to write just 60 to 70% of that answer in your exam. So you don't need to reproduce the whole answer, guys. So I hope everyone is clear. So if you have any doubt, so please do let me know. If it's okay, if there is no question, then just write okay. Nazis is asking, so whether what are the total marks? 9 marks and then 2 marks. So the total marks for this part was 11 marks, but there is still one adjustment required. So you can say that we have around 11 marks, and you can say that 6 to 7 marks was for this adjustment, and the remaining adjustment carries five marks, around 4 to 5 to 6 marks. Is that okay? So 6 to 7 marks for this adjustment and 4 to 5 marks for the other adjustments. Now, this is, now, yeah, guys, what is a second adjustment that we need to solve here? That is, again, answer granted to 50 cash settled share awards. So cash settled share awards means share-based payments. So what I'm going to do, I'm quickly revising share-based payments, and then we will be solving this part. But before this, I just want to solve another part of share appreciation rights, which is a little difficult one. So we will solve that part, then we will come again back to this question, okay? So now we are going to revise share appreciation rights, IFRS to cash settled share-based payments versus equity settled share-based payments. So we are going to discuss both of these parts, okay? So let's understand, guys, what is share-based payment. So this is IFRS 2. IFRS 2 deals with share-based payments. IFRS 2 deals with share-based payments. What are share-based payments, guys? First, we need to define what is share-based payments. The share-based payment is when entity receive goods or services. When entity receive goods or services. So when entity will receive goods or services, and in exchange of that goods or services, and in exchange of that goods or services, and in exchange, they offer, in exchange, in return, by taking goods and services. So when entity receive goods or services, and in exchange, they offer, own company shares, own entity shares, own shares. We are not talking about other companies' shares. We are talking about own company shares. So we are taking goods, we are taking services, we are taking building, we are taking plants, machineries, biological assets, and in returns, what we are giving them are own company's shares. This is share-based payment. Or we offer them cash. We are saying that we will pay in exchange. Will pay, will pay. I'm talking about will pay. It means in future we are going to pay a cash, but that cash should be based on shares. That cash should be based on shares. So this is again a share-based payment, because this payment, although this payment would be in the form of cash, but this payment is dependent on your share price. So it is based on shares. So there are basically there are three types of share-based payments, but we are talking about two types of share-based payments. The third one is where they have choice. They can pay in the form of cash. They can offer the shares as well. Now, guys, we need to divide these share-based payments basically into two categories, although there is third one as well, which is choice of settlement. So in equity settled share-based payments, in exchange of goods or services, we are taking goods and services. But in exchange of goods and services, what we are offering them, our own shares, our own share options. Share options means we are saying them that we will issue shares in future. So what is the difference between share and share option? Shares is that you are actually issuing them shares right now, but share option is that you are just making a promise that we will issue shares in future. So the promise to issue shares in future is actually share option. So we call them equity instruments. So what actually the other party, the supplier of goods, the counterparty is receiving our company's equity. So that's why we call them equity settled share-based payment. Means what actually the supplier of goods services received from us is the equity of our company. So equity settled share-based payment, the transaction which is settled in equity. On the other hand, we have cash settled share-based payment, where goods or services being received in exchange of cash based on share price. So you are actually offering them cash, but based on share price. Like you are saying that we will pay you, we are acquiring building from someone, and we are saying that we will pay you a market value of 2 million ordinary shares of our own company. So obviously, if the counterparty, the supplier agrees, the transaction will happen. Otherwise, the transaction will not happen. Now, guys, what is next? So what should be the journal entry? It's very simple. You need to write debit expense or asset. If you are acquiring building, then you need to write building. If you are acquiring inventory, you need to write inventory. If you are acquiring plants, then you need to write plant. Means plant, inventory, they are assets. But if you are receiving services, then they are being consumed immediately. Like with employees, you are taking services from the employees, and you are giving them shares, or you are promising that you will issue shares, means you are giving them share options, then the debit would be expense. So it could be asset, it could be expense, and the credit should be equity. The most important thing is the credit would be equity. On the other hand, if you are actually promising them that we will be paying them cash after some time, then obviously you need to create a liability. Debit, if goods are coming, if the assets are coming, it will be asset. If services are there and services are being consumed, then obviously it will be expense. So guys, the third point is the liability will not be remeasured. Liability will not be remeasured, and here the third point is that the equity will not be remeasured, but the liability will be remeasured to its fair value at each reporting date. What does it mean? Let's have a look to the formula how to calculate share-based payments. So how to deal with share-based payments? Listen carefully, guys. Look, the share option plan is the best example of share option plan is the best example of equity settled share-based payment. Share appreciation rights are the best example of cash settled share-based payments. So what are the formulas to record share option plan and share appreciation rights? So you are going to take number of options expected to vest. What does it mean? We will talk about it in a while. Then we'll be taking fair value of option at grant date. So we will take fair value of option at grant date. Grant date means contract date. And we are not going to revise. If we have to solve 3 years calculation, we have to solve 3 years calculation then in first year we will take fair value of option at granted. Second year we will take fair value of option at granted. In third year we will take fair value of option at granted. And we are going to multiply with time ratio. Obviously, for 1 year, time ratio would be 1/3. If total number of years are 3 and you are calculating for year 1, then it will be 1/3. Then for second year it would be 2/3, and for third year it would be 3/3. Share appreciation rights are number of SARs expected to vest. What is SAR as share appreciation rights? Multiply by fair value of SARs at each reporting date. This is important, that the liability is being measured at each reporting date. You have to change the liability value at each reporting date. But in equity, you are not going to change it. Equity will not be remeasured, but the liability will be remeasured to its fair value at each reporting date. So this is an important thing in the formula. Then, guys, what is the fourth point? Fourth point is that when you are going to allocate the expense, if you have vesting period, means condition period. If you are saying to employees that employees, you have to work for us for 4 years, then it means they are providing service for 4 years. They are giving services for over vesting period. Condition period is 4 years. We call vesting period condition period alternatively. So they have to work for 4 years in order to get the payment. It means whatever we are paying is for 4 years. So it should be expensed out over 4 years rather than immediately. So if we have vesting period exist, condition period exist, expense should be allocated over vesting period. But if there is no condition attached, the payment has immediately vested, it means they qualify for the payment. We are giving them payment. There is no condition attached. So we are just giving them shares and we are saying that these shares belongs to you. There is no condition due to your past performance, maybe due to some extraordinary performance, we are giving them these shares. We will say that this belongs to you, so the expense should be allocated immediately. But when there is a vesting period, then you have to apply a time ratio. Means if total condition period is 4 years, if the total condition period is 4 years, what you need to do, guys, if total condition period is 4 years, what you need to do? Then for 1 year, you will be writing 1/4. Second year, you will be writing 2/4. And third year, you will be writing 3/4, and fourth year by 4/4. In the same way, you are going to take these values as well. So the allocation points are same for both types of share-based payments. So what are number of options expected to vest means you have to take options of those employees, about only those employees who are expected to qualify for the share-based payments. What does it mean? If you have shared a plan with 10 employees, you shared a plan with 10 employees, what does it mean, guys? Now you are saying that if an employee will work for us for 4 years, then we will be giving them shares. Otherwise, if someone will leave, we are not going to give them shares. Now, the condition is they have to serve us for 4 years. We call it service condition, but this is not important. But the important thing is there is a condition. So there are 4 years condition. Now, if you are at end of year 1, when you are calculating year 1 calculation, if you think that 3 employees will leave the company, it means you should do calculation only with 7 employees, and that's it. So if one employee has 1,000 options, 1,000 options means we promise them that we will issue shares. We will issue 1,000 shares to them after successful completion of 4 years. Now we expect that 3 employees will leave. Then it means we need to do calculation with 7. And it is an estimate, and estimates will revise every year. Here we expect that only 2 will leave in total. Then it means you need to do calculation with 8. Here you think that only 3 will leave, then obviously you will take with 7. And here you will move towards actual employees. And when actually employees left, you came to know that only actually 1 employee left, and you are working with 9. So you are going to change these options expected to vest every year. In the same way, obviously, you are going to change the share appreciation rights every year as well. Now let's put this let's have an example of basically share appreciation rights, and then we will learn from that example how to apply this formula. The difference between these two formulas would be, what would be the difference between these two formulas? In share appreciation rights, in cash settled share based payments, because you owe an amount, you have a liability, so you need to remeasure it every year. But in share options plan, you don't remeasure it every year. So this is the first difference. And the second difference is, here there would be a liability. In this plan, there is a liability. And in this plan, there is an equity. We know that if we will wrongly classify equity as liability or liability as equity, we will obviously affect many ratios. The most important ratio is obviously the gearing ratio. So this is something that we need to learn. Now we are moving towards a question, but before that, just one more thing that I just want to revise, and that is one more thing that I just want to revise, and that is how the settlement entries will work. Okay, here you have to pay ultimately at the time of settlement, at the time of vesting, at the time of settlement. What would be the journal entries? You have to pay cash, so the liability will decrease and you have to pay cash. And if there is any difference between liability amount and cash payment, that will be charged to P&L. And here you have to pay shares. If you have to pay shares, then what will happen, guys? What we need to do is, usually we write it equity options. So we will debit equity options initially, and then ultimately you are going to credit share capital and share premium. Sometimes when we issue shares to them at vesting date after completion of condition period, we ask them some exercise price, means we ask them some cash. So if there is some cash, then obviously that will be debited again. So this is something that I just want you to learn right now. Now we are moving towards a question. And someone is saying that, can you please explain group share-based payments? Again, guys, I have to refer you back towards, again, group share-based payments. So I would say that I have explained group share-based payments in detail in September 21 practice to pass session. So please watch that videos. It was in day 5. Day 5 was the day when I discussed group share-based payments in detail. Okay. Now, guys, we need to solve this question. The question is, again, a past paper question. I picked this question from, again, a BPP exam kit. So here is the source, BPP exam kit. Now, guys, what is the accounting treatment? This is, again, for 6 marks. Prepare a briefing note for the directors of Yanong, which answers their queries related to the SARs. Sometimes the questions have hidden requirement here. Look, this is the requirement. What are their queries? What they want to know would be the question, guys. So what is the question, guys, here? Listen carefully. The directors of Yonong would like to confirm how the SARs would have been accounted for from the grant date to 30th September X8. So this is important. They are asking you to give treatment from grant date to 30th September X8. Okay. So if the grant date is in October 2005, so you have to calculate 2006, 7, and 8. If the grant date is in 2004, you have to calculate 4, 5, 6, 7, and 8. So this is really an important thing. Now, grant dates and whether IFRS 13 fair value measurement and whether IFRS 13 fair value measurement or IFRS 2 share-based payment applies. So they just are asking that whether IFRS 13 will apply to the share-based payments or not. We will talk about this as well. But right now, I'm going to give you the accounting, and then there is a second requirement as well. If you are not going to answer this requirement, then obviously you'll lose an easy mark, boys and girls. So this is interesting. Now let's see what is the actual requirement. Moise has in equity investment in an entity called Unite. So Moise has an equity investment. So Moise has an equity investment. Okay, bhai. The directors of Unite are inexperienced and would like to confirm how much share appreciation rights should have been accounted for. The details of SARs are as follows. On 1st October X5, Y company granted 500 share appreciation rights. We know it is share appreciation rights. Share appreciation rights means it is the cash settled share based payment. So we need to remember what are the basic concepts. Cash settled share based payment, there would be a liability. The second point, liability will be remeasured at each reporting date. Expense will be allocated over vesting period. If there is any condition period, then expense will be allocated over vesting period. So 500 share appreciation rights to its 300 managers. So 300 managers are there, 500 share appreciation rights to each manager. All the rights vested on 30th September X7, all the rights vested on 30th September X7, but they can be exercised from 1st October X7 to 30th September X9. They can be exercised in X7, X8, X9, but they will vest at 30th September X7. What does it mean, guys? Look, so the grant date is, what is grant date? The grant date is 1st October 2000 X5, and your year end, the vesting date is 30th September X7. 30th September X7. So it means we have vesting period of how many years? So the first year will end at 30th September X6, and the second year will end at 30th September X7. So we have a vesting period for 2 years. So we need to charge expense, remuneration expense, service expense over 2 years. Here I'm going to use the time ratio 1/2, and here I'm going to use ratio 2/2. And they can exercise these options, these rights at any time in 2000 X8 or X9. So what is next now, guys? So what is next treatment? The next treatment is on first, okay, or at the grant date, the value of each SAR was 10. So now the next point, what is next point? That I will not use the value at grant date. This is share-based payment and the cash settled share-based payment. I'm not going to use this value, which is the value of grant date. I'm going to remeasure it again and again. So, and it was estimated that 5% of 5% of managers would leave during the vesting period. 5% will leave. What does it mean, guys? So we have witnessed this in the previous slide, that if we know that 5% will leave, so we should do calculation with 95%, because we need to take the number of SARs expected to vest. We will calculate expense for only those employees who are expected to meet all the conditions, who will remain with us for 2 years, who will meet the condition. Now, so it means you have to calculate you have to do calculations with 95%. During the vesting period at 30th September X6, the estimate of how many managers would leave during the vesting period remained at 5%. So they are saying that at 2000 X6, it is again 5%. So obviously we need to use the estimate of this date. If the question have mentioned, if the question will mention that 6% will leave, then obviously we need to use this estimate. So we are going to use the estimate of year end rather than the grant date. Okay. So 5% will leave. The fair values of SAR as follows. So fair value of SARs is given. So now we need to calculate. So guys, first year calculation would be year one calculation, which is a calculation at 30th September X7. So total in number of employees were 300. So I have to calculate calculations. I have to do calculations with 300. No, I have to do calculation only with 95% who are expected to stay with us to meet the conditions. And every employee has 500 SARs. So this is 500 SARs. This will give me number of SARs expected to vest. This is my expectation. Now you need to multiply it fair value at grant date or fair value at reporting date. Obviously fair value at reporting date. We will not use this 10, we will use this 9 at reporting date. Fair value of SAR is 9. So and we have to multiply it with time ratio. So this is the formula, guys. Now what is the answer? So there would be a liability. So we have a liability and we need to create an expense as well. So what is the liability, guys? So 285 employees into 500 into 9 into 1 by 2. So someone has asked me how we know that it is for 2 years. It is mentioned in the question that when they are going to vest. It is mentioned in the question when they are going to vest. It is mentioned in the question when they are going to vest. So let's understand, guys, when they are going to vest. Look, I'm just highlighting the time, this thing. Okay, this is the starting point, and they are saying that all the rights will vest on 30th November 2000X7. So if the rights will if the rights will if the rights will vest in September X7, obviously we need to do this over 2 years. But yes, they can ask for shares. They can ask for shares after maybe after 2 years, maybe after the third year, maybe in third year, maybe in fourth year. Yeah, they can ask payment for third, fourth year. Now, guys, what is next? What is next? Now we need to do calculations. The liability amount is actually 641. Liability amount is 641. 250. And the expense amount is again 641,250. Now I just want to do calculation at 30th September X. This is X6, this is X7. Now I'm going to solve the X7. This is X6, guys. Now in X7, X6, X7, we need to do the calculations with the actual number of employees. So I just want everyone to read this and tell me, just tell me this line. Tell me for how many employees we should do calculation for this share-based payment. So please tell me. Okay, I was not speaking, Komal. So let's listen carefully now. Now, I was not speaking actually, and I was not calculating anything. So listen carefully now, guys. So what is next thing? 2007. So again, they are saying that we expect that 5%, we were expecting that 5% will leave, and they actually left the company. Okay. So it means we need to do the calculations again with 285 employees. Again, 300 into 95%, the 95% of 300. We need to multiply this with 500. This will give us share options, actually share as rights actually vested into. Do we need to use 9, or we need to reach again revise this to year end? Yes, we need to revise this again at to 11. So this is 11, guys. So we will be taking 11 here. Look, into 2 by 2 is the time ratio. So what would be the liability, guys? Just tell me what would be the liability. What is the liability, guys? Give me the value, guys. It is 1.5 million 1567500. This is liability. Now, what would be the expense? This is 2 years liability, guys. This is 2 years liability. Look, if you are multiplying this with 2 by 2, then it means it will give you 2 years liability. Now, what we need to do, if this is 2 years liability, what we need to do? Now, we have to deduct 1 year's liability from this, and we'll get the expense for 1 year. So how we are going to calculate expense of this second year? This is 2 years liability. We are going to deduct 1 year's liability from this. And the expense would be 926,250. So this is something that is again an expense. Now, guys, what they are saying on 30th September X8, this year is going to be an important year. On 30th September X8, 60 out of 300, out of actually 285, because 285 vested, 285 out of 285, 60 managers exercise their options. Where the intrinsic value of the right was 10.50. Intrinsic value means the amount that you are paying them. This is the amount that actually you are paying them. So cash paid will be the intrinsic value, and were paid in cash. So they are saying that 10.5 is being paid to the 60. Now, guys, this year is going to be an important year. So listen carefully. What we are going to do, listen carefully. So what we are going to do at 30th September X8, out of 285, if 60 has exercised their rights, so it means 60 has exercised their rights. What are the remaining number of employees who didn't exercise their rights? We still owe them amount. 60 are the number of employees who are asking for money. So we are going to pay to these 60 people, and the remaining 225 are the employees. We still owe them an amount whenever they will ask, because they can ask in 2000x8 or in 2000x8. It means the remaining will ask cash in 2009. So, guys, to these 60 employees, every employee has 500 share appreciation rights. Look, every employee has 500 share appreciation rights. So they'll ask for cash for 500 share appreciation rights. So these are the total rights, and we are going to pay them 10.5. No time ratio, because the expense has been charged over 2 years. Now it is just a payment that is being made and there would be some fluctuation in the liability, and that fluctuation is actually fair value movement rather than the remuneration expense. So what would be the payment? So we are paying them, guys. This is the amount that we actually are paying them: 315,000. So this is the amount that we are actually paying them. Now what is next step? So how much liability is still on us? How much we still owe to these 225 employees? Liability will be recognized at fair value. Liability will be recognized at fair value, guys. What is the fair value? In 2000x8, this is important. What is the fair value? This is 12. So we need to write this at 12. Liability will be recognized at 12. So what would be the liability, guys? So just give me the liability value. What is the liability value? So this is 1350. So this year entry, this year treatment is going to be, look, this is new liability. Now, guys, what is the expense or income during the year? So we need to understand what is the expense during the year. So it is very simple. So what should be the journal entry, double entry? What should be the journal entry for to record this 2000x8 payment? So look, this is an amount that we are actually paying. So what we need to do, if we are paying cash to someone, our cash is reducing. So if our cash is reducing, what does it mean? I have to credit cash. So I have credit cash by how much? By 315, because this is the amount that actually I'm paying to, to the employees who have exercised their rights. So now your liability, look, this is important. Your liability at the end of 2000x7 was 1567500, but now after settling your liability is 1350. What do you think, guys? What is the decrease in liability? Liability has decreased by how much? There is a decrease in liability, guys. What is the decrease in liability? Look, initial at 30th September x7, the liability was 1567,500. So you need to debit liability by how much? The new liability is 1350. The previous liability was 1567. So what we need to do, we need to reduce liability. To reduce liability, we need to debit liability. In simple terms, you can say liability settled. What is the amount of liability settled? Look, 1563,500 minus 1350. This is 1350, guys. So what is the difference between these two liabilities? Tell me the difference between these two liabilities, guys. Everyone. Thank you so much. So yes, you are right. Okay. So I'm going to debit liability by 217,500, guys. So guys, the liability is being settled. We are settling liability. We are settling liability of 217,500. Our liability is decreasing by 217, but we are paying 315. We are paying more than the liability settled. My liability is decreasing by 217,500, but I'm paying cash of 315. What does it mean? I'm paying more. And if you are paying more to settle the liability, it means this is your expense, and this expense should be charged to P&L. So this expense should be charged to P&L. It could be an income if the reduction in liability is more than the cash paid. So this is expense for 97,500. So this is how you are going to treat cash settled share-based payments. But the answer is not complete yet. Yeah, guys, there is another requirement that is left to answer. And what is that requirement? That is IFRS 13. Guys, IFRS 13 is applicable to every standard, but there are two exceptions. Is there anyone who knows about the exception? Yes, there are two exceptions. It is not applicable to leases. It is not applicable to lease, which is IFRS 16. And it is not applicable to IFRS 2, which is share-based payment. Other than that, IFRS 13 is applicable to each and every standard, but obviously there are certain things which are not fair value. Like NRV, net realizable value, is not a fair value. The recoverable value is not a fair value. So these values are not fair value, not fair values. So these are not fair values. So guys, this was the question on IFRS 2 for 6 marks, and I have revised share appreciation rights. Now we are moving towards our original question, which is on analysis area along with certain standards, obviously. So what is that? If you have any questions regarding this part of the question, you can ask the question, guys. Is there any question? Okay, brilliant. If you don't have any questions, so let's move towards the part of the question that we actually want to solve. So guys, this is the part of question. This is a part of question. So listen carefully. So I just want you to read and to solve. You have just 3 minutes to do that, 3 to 4 minutes, and that's it. So I just want everyone to read this and solve. So there is nothing in the next slide. The next slide is actually, you can pick the year end, which is 30th November X7. Your year end is 30th November X7, guys, and I just want you to read this paragraph and just tell me what is the problem with this paragraph. What is the problem with this paragraph? Is the treatment given is correct treatment or not? And what would be the obviously impact on the capitalization table, the table given in the question, and obviously what would be the impact on two ratios? So just take it 3 to 4 minutes and answer, guys. I'm waiting. I'm waiting, guys. Brilliant. Someone is saying that Amster has classified it equity rather than liability. Brilliant. Is there any problem with the amount as well? Okay, they have wrongly credited to liability. They have wrongly credited to equity. Okay, fine. But is there any problem with the amount as well? Brilliant. So just do let me know, guys. Okay, let's understand now. On 1st December 2006, Amster granted 200, Amster granted 250 cash settled share awards. Cash settled share awards means cash settled share based payments. We're talking about appreciation rights. 250 cash settled share based payments awards to each of its 1,500 employees on the condition, there is a condition attached, that the employees remain in its employment for the next 3 years. So employees have to live for the next 3 years, have to work for the next 3 years. What does it mean, guys? What does it mean? There is a condition period for 3 years. So now what you need to do? You will do calculations 1/3 for 1 year, time ratio. You are going to portion this expense over 3 years. Cash is payable at the end of 3 years based on the share price of the entity's share at that date. This is share-based payment. During the year to 30th November X7, 65 employees left, and at that date, Amster estimate that an additional 115 employees will leave during the following 2 years. So it means we need to deduct this 65 who have left the company, and we need to deduct these 115 who are going to leave, because we are going to calculate with expected number of employees who are going to complete 3 years. So we need to deduct the employees who has left. We are not going to deduct those who are we are expecting to leave. So will leave during the share price at 30th November X7 is 35 per share, and it is anticipated that it will rise to 46 by 30th November X7. It will rise to 46, but we are going to write 35 or 49, guys. Just tell me, we are going to write 35 or for 30th November X7. We should write 35 or we should write 46. Please do let me know. What is the formula? Do we need to take fair value at year end, or we need to take fair value at vesting date? Obviously, year end. So what we need to do is we are going to calculate, guys. Yes, we measure at each reporting date. So guys, total number of employees were 1,500 employees were there. Okay, 1,500 employees were there. 1,500 employees were there. Now what we need to do? We need to deduct how much? 65 who has left the company, who have left the company, and 115 who we are expecting will leave the company. So 115 into, we have how many share awards with each employee? It is 250. Now we need to multiply this with year end value, which is 35, and this is going to be 1/3 or 1/2. This is going to be 1/3 or 1/2. So the value is, how much value is there, guys? What is the answer of this? Yes, we need to multiply it with 3.5, 1/3. So what would be the value? I think it would be 3.85. It would be 3.85. Yes. So Amster has charged the expense to P&L and credited equity with the same amount. So what they have done is they have charged an expense and they have credited it to equity, but we know that the correct entry should be expense to liability. Instead of writing a liability, they have write equity. So we will say that we need to adjust. So what we need to do, guys, we have to debit equity. We need to debit equity and we need to increase liability. So decrease the liability, decrease the equity in capitalization table. So I'm going to decrease equity by 3.85 and we need to increase liability. And what is the value of liability, guys? We are going to increase liability by 3.85. So this is my revised capitalization table. So 30th member X7 revised values are there. So first value is 84.85. This is 30. This is 0. The total liability would be, total long-term liabilities would be 114.85. Non-controlling is still non-controlling is still 10. There is no adjustment. Shareholders' equity would be 221.15. So total equity is 231.15, and this is again total capital is again 346. This is again 346. There's no difference between total capital. So this is the amount, guys, 246. So this is the revised capitalization table. Now, if you have any questions, the answer is not complete yet. You have to tell the impact on gearing and capital employed. So give me the impact on gearing and capital employed. They have charged expense, guys. There is no impact on profits. But yes, we need to increase liability. We need to decrease equity. So obviously it will affect gearing ratio. It is going to increase gearing or it is going to decrease gearing? Yes, it is going to increase gearing. Brilliant. Thank you, everyone. This was a question on Amster, and basically this was the question with analysis part. So this is how they are going to test 2 or 3 standards in one question, and they will ask you something from interpretation. So this was a question to give you an idea how a standard can be tested along with interpretation questions. Now we are moving towards the next part, which is IFRS 15. Again, a simple IFRS 15 part, but for 5 marks. And for this, we need to revise certain things. So this is our revision for IFRS 15. This is the basic concept that we need to apply. What is this basic concept? I just want everyone first to read the requirement question, and then we'll come back to this part. Okay, we have Mr. Robinson. I can't seem to text in chat. If sir, if we were working to your 2009, we would have just deduct 65 for 2007, then work the other portion minus 115 at 40. No, Mr. Robinson. Yes, the chat option is not open, so you can ask questions here. I'm watching your answer actually. No, this is not the case. You have to deduct all the employees who have left the company and who we are expected to leave the company. So you need to always deduct. Okay, guys, we have questions from the previous part. Let's take some. Let me answer these questions and then we'll move. Okay, so what is the part? Just wait, guys. So we have questions here. Okay, the first question is, sir, when do we use the 40? When do we use the 40? We don't have 40 value here. We do have 46, boy. But where is 40, guys? Then we have again a question why we do not calculate for second and third year. Because the requirement is only for 2007 and that's it. The requirement was not for 2008 and 9. So we don't need to calculate for 2008 and 9. There was only one capitalization table. The question was, what are the errors in the accounting which they have already done? Adjust the capitalization table, give the impact on capitalization table, and give the impact on ratios. So that's why we didn't calculate the next 2 years. Okay. Now what is next? 40 per share estimate for 2009. Okay, this is actually 49 for me in my question. This is actually 46. This is 46. Okay. Look, we are not going to use this. We will be using this amount, the year-end fair value, the year-end value. But if we will be solving the question for 2000x8, we will use the value of 2000x8. If the value is for 2000x9, then we will use 2000x9 value. Otherwise, we don't need to calculate 2000x9 value. So we will not use 2000x9 value in 2007, boy. Okay, then so there is another question from the previous part, and that is why we are taking this 95 if no employees has left. Why we are taking this 285 if no employee has left. Actually, employees has left. Please listen carefully. This is the question. Look, all the managers who were expected to leave, and we were expecting that 5% will leave, 5% will leave, who were expected to leave employment did leave the company, did leave the company. It is already given. So that's why we are using 285. Otherwise, if the line was that we are the actual number of employees who left the company is 4%, so we have to deduct 4% or only 4%. Is that okay? Okay, thank you so much. Now let's move towards next part, guys. So this is the question. that we need to read. So let's see what is in the question, and then we will be talking about whether the accounting is acceptable, accounting treatment is acceptable or not. So listen carefully now. Advise the directors with reference to underlying principles of IFRS 15, revenue from contracts with customers. Advise the directors with reference to the underlying principles of IFRS 15, revenue from contracts with customers, how the revenue in relation to the contract should be recognized. How the revenue should be recognized. You need to advise. 5 marks. So let's understand what is the question. Each is seeking advice on transactions it has entered in the year ended 30th November X6. So year end is 30th November X6. This is again a past paper question that I have picked from BPP exam kit. Now each owns a chain of health clubs and has entered into a binding contract with sports organizations, which earn income over given periods. The service rendered in return for such income includes access to its database of members and admissions to health clubs, including the provisions of coaching and other benefits. These contracts are a period of between 9 and 11, 18 months. Maybe this is a contract for 12 months, maybe for 13, maybe for 15, maybe for 18 months. So usually the contract period is from 9 to 18 months. Now, each accounting policy, this is important, each accounting policy for revenue recognition is to recognize the contract income in full. In full. Is saying their policy is to recognize contract income in full at the date when the contract is signed. So you have to counter this argument, whether it's a correct accounting treatment, whether it's a correct accounting policy or not, whether they can do that or not. The standard which is applicable on revenue recognition is IFRS 15. So please do let me know. So can you explain over the entries in the end for the last line of para? Okay, we can do that, but obviously at the end of the session, or we can talk in the WhatsApp group. Okay, so just wait. Now, please do let me know whether they can do or not. You can't say simply a no. You can't say simply a yes. You have to tell why you are saying that they can't do this. You have to tell why they can't do this. So this is something that should be, that you have to present in your answer, that why I'm saying that they can't do this. Okay. Okay, guys. Just have a look of my thinking process. What is my thinking process on IFRS 15? So they are saying that they recognize the revenue recognized in full when the contract is signed. So I will see whether this is step 1. Revenue recognition? No. Is it step 2? No. Is it step 3? No. Is it step 4? No. Basically, it is step 5. Basically, it is step 5. Step 5 says you can recognize the revenue. You can recognize the revenue. So what you can do, you can recognize the revenue. So you can recognize the revenue when or as performance obligation satisfies. When or as performance obligation satisfies. So when are as performance obligation satisfied, it means you can recognize the revenue if you have satisfied the performance obligation. What does it mean? It means if there are goods, you have delivered the goods along with its risk and rewards. If it is services, then you have rendered the services. If it is services, then you have rendered the services. In order to recognize the revenue, first you have to in order to recognize revenue, first you have to satisfy the performance obligation. First you have to earn that. What does it mean? It means the task which is given to you, you should have performed this before booking the revenue. So the contract here is that you will provide service, you will provide admission to the health club, you will provide them coaching services, you will provide them access to the database. So this is something that you actually have to provide them. So at the time of contract, you can't book a revenue at the time of contract. So in services, we know if we are delivering services, so in services, we recognize revenue over period of time. We recognize period of time. And in case of goods, we recognize revenue at point of time. But that point of time is not a contract signing date. That point of time is when you have delivered some goods, when you have delivered goods, along with its risk and rewards, along with the control. So at point of time. So this is something that you need to understand. So guys, do let me know whether they can book a revenue or not. Please do let me know whether they can book a revenue or not. Obviously not, because they didn't delivered any goods, didn't rendered any services. Okay, now what is next? So the rationale is that the contracts are binding. They are saying that we are saying this because the contracts are binding, and at the point of signing the contract, the customer gains access to age services. So if they have gained access, they can, we have provided them access. It means we have rendered our service? Obviously not. We will render service when they will consume our services, when they will use our health club, when they will use our coaching and other benefits, our coaching services, and they will, when they will enjoy. So that's the time when our PO will be, satisfied. So they can't book a revenue. The directors are reluctant to change their accounting policy. So just do let me know why they are reluctant to change your policy. So you need to tell why they are reluctant. Just tell me why they are reluctant to change their accounting policy. They don't want to change the accounting policy. They don't want to change accounting policy. You need to tell them why they are reluctant to change their policy. Obviously, it will reduce their revenue. They want to show more revenue. The most easiest way to show your profitability on a higher side is to increase your revenues. They want to increase the profits. So they don't want to decrease their profits, because we are saying that the revenue should be allocated over the period of time. Revenue should be allocated over period of time. So you need to tell them this as well, because directors are saying they are reluctant to change, and you will say that it will affect their profitability and obviously their performance. Now, guys, how to book a revenue of this in this contract? So please, we need to apply 5 steps. So just tell me, is there a problem of step 1? No. Is there any problem of step 2? Step 2, yes. What are the promises that we are making with the sports organizations? What are the basic promises that we are making them? in a contract. We call them performance obligations. So how many POs are there? How many POs are there? Just do let me know how many POs are there. How many POs are there? So step one is identify the contract. Step two is identify the performance obligations. So how many POs are there, guys? First three lines, guys. First three lines. Okay. So let's understand. Let's understand, guys. Okay, let me explain. H owns a chain of health clubs and has entered into a binding contract with sports organization which earn income over given period. The service rendered in return for the such incomes includes the first thing is access to H database of members. So the first thing is that we will give them access to H database of members and admission to health clubs. The second thing is we are saying that they can admit in health club and they obviously can use the health club facilities, including the provisions for coaching. This is provision for coaching. It means we will provide them coaching service as well as other benefits. So we can say there are four POs. We can say that there are four POs. And we can say there are two POs like H database, we are giving them access, and the other one is we are giving a facility of health club in which we have including coaching and other benefits. Okay, now the problem is there any goods? Is there any goods which we have delivered and that's it? Or this is something that you have to provide every month of service? So all these things you have to provide like they can access to H database of members. Why they need an access to H database members? Because they will promote things, sports organizations, they will promote their things, they will promote their products to the members. So they are going to constantly access the data or they'll just access and that's it. So the members will keep changing, guys. So it means they will continuously be looking for this data. It means this is something that we are providing over service, over time. We are providing over time. Then health club facilities are also being provided over time. They can enjoy every day these health facilities. In the same way, we are giving them coaching services and other benefits. So guys, it means the patron of providing service, patron of providing all these POs, all these benefits to the customer is same. So we can say that we should book the revenue over period of time. We should book revenue over period of time for all these performance obligations, And the best basis is time basis or straight line basis. You can say that you can book a revenue on time basis. What does it mean? That if we have received total amount of 800 for 16 months, then what we need to do? We are going to recognize a revenue of $50 per month. So time basis is the most appropriate basis here, that you should book revenue on the basis of time. Is that okay, guys? Thank you, everyone. Sir, how many POs can you repeat? I understand over time. Okay. Basically, there are four POs, but the pattern of providing the POs, the pattern of providing service for all POs is same. we need time to provide these services. They are taking these benefits every day. So we will say that because the pattern of providing benefit is same, so we will recognize revenue for all these 4 POs over time. So we don't need to split into 4 POs because the delivery pattern is same. And now you can read this, guys. You can read this. So this is IFRS 15's related paragraphs that are required to answer the question. So just you can read this. If you have any question, then please ask a question. So I'm waiting, guys. I'm waiting for your answer. Okay, guys. So now we are moving towards, is that okay, guys? Now we are moving towards next part, which is from IFRS 5. So we need to revise some IFRS 5, and then we will be solving this part. So this is the content that we need to understand, guys. Okay, let's start, guys. So assets held for sale and discontinued operation. The discontinued operation, you must be aware of the impact of discontinued operation on consolidation. Whenever we have a disposal of subsidiary, whenever we have disposal of subsidiary, we can say that that subsidiary sold can be classified as subsidiary disposed can be classified as discontinued operation. This is important. Then what you need to do, then the consolidation procedures will be same. You have to eliminate unrealized profits. You have to pick the subsidiary assets and liabilities. You have to pick subsidiaries profits. The process will be same. You have to eliminate intra-group receivable payable. But if subsidiary has been classified as discontinued operation, then you have to present this subsidiary's profit or loss as a single line item. Single line item, profit or loss. So profit or loss will be a single line item. So you are not going to add subsidiary and parents revenues. You are not going to add subsidiary and parent cost of sales. So let me give you an example. One more thing which is important here is sometimes there is a subsidiary exclusively acquired for resale. If there is a subsidiary exclusively acquired for resale, then it is a subsidiary. We have control, so we need to consolidate. Subsidiary exclusively acquired for resale, but this subsidiary can be classified as discontinued. So if it has been classified as discontinued, what to do? So this is something important. Please listen carefully. So guys, disposal of subsidiary, whenever there is a disposal of subsidiary sold can be classified as discontinued operation. If there is a subsidiary exclusively acquired for resale, that can also be classified as discontinued operation. Okay, fair enough. What is next? The next is how to consolidate. Okay, so let me explain through an example. Look, so we have sales of parent, subsidiary, and S1. This is a subsidiary which has been classified as discontinued operation. Okay, we have cost of sale, we have gross profit, we have other expenses, and we have ultimately profit after tax. There is no problem with other comprehensive income. So what we need to do, guys, what is your understanding about this? Please do let me know. So what we are going to do, we are going to add, this is discontinued operation. This is discontinued or held for sale means. So this is discontinued operation. Now what we are going to do, we will add these parent and subsidiary. We will add this parent and subsidiary. We will add these expenses of parent and subsidiary, and obviously the PAT as well. We are not going to add line by line income expenses of this subsidiary. So what we are going to do, we will pick the profit or loss from this discontinued operation, profit or loss, and we will show it as a single line item, profit or loss from discontinued operation. So you must be aware, profit or loss from discontinued operation, that how to present a subsidiary which has been classified as discontinued operation. So profit loss from discontinued operation. Profit loss from discontinued operation. So this is important, guys. Is that okay? Please do let me know. So the question is, does it applicable to the part disposal as well? Yes, to every disposal where we lost control. Obviously, to every disposal if we lost control. But if still we have control, then it means we didn't dispose subsidiary. If we lost control, yes, it is applicable to every situation where we have lost control. Means if the previously it was a subsidiary, now it is an associate, it is applicable. Then if previously it was a subsidiary, now it is a simple investment, then it is applicable. Okay, and complete disposal, it is applicable. Okay, but there are certain other criterias as well. The other criterias are, like, if you want to present it as a discontinued operation, then it must be a separate geographical region. There are questions in the past papers where they said that we want to sell a subsidiary, but we have sold a subsidiary, so separate geographical region, but the subsidiary was operating in a region where we have other subsidiaries as well, we have other operations as well. So it means it is not a separate geographical region, so we cannot classify it as a discontinued operation, or it should be a separate line of operation. But it must be either a separate line of operation or separate geographical region. So there were questions in the past in question 1 where the examiner has asked whether a subsidiary can be classified as discontinued or not. But the problem was that we have other operations in that geographical region, and we have similar operations in other parts of the business as well. So we have to conclude that because it is not a separate geographical region, it is not a separate line of operation, so we cannot classify this as a discontinued operation. I hope everyone is clear. Now, guys, how to present in balance sheet? This is another part. How to present in balance sheet. So this is again an interesting thing. Sir, how to present in consolidated SOFP a subsidiary which is not yet disposed, it is held for sale. Look, subsidiary exclusively acquired for resale, but it is not yet sold. It will be sold soon in the next year. Held for sale criteria are met. It is a discontinued operation. Now, what we need to do, guys? Do let me know what we need to do, please. So, what we need to do now? Sir, we cannot combine all the assets of discontinued operation or discontinued subsidiary. So what we are going to do, we will combine all the non-current assets of disposed subsidiary with current assets along with goodwill, every asset, and we will present them under the headings of current assets. So we will present them under current assets heading. All the assets of discontinued subsidiary will be presented under current assets heading. In the same way, all the liabilities, long-term liabilities of discontinued operation plus short-term liabilities, you need to combine all the liabilities of discontinued subsidiary, and you have to present it under current liabilities, under the heading of current liabilities. So this is what you need to do, guys. If there is a subsidiary which is subsidiary exclusively acquired for resale and has been classified as discontinued operation, but if the subsidiary has been sold, obviously we will not consolidate its balance sheet because we have lost control. We are not going to consolidate SOFP, but yes, we have to consolidate P&L even if the subsidiary has been disposed. Because if we have disposed subsidiary for 6 months, after 6 months, we need to consolidate 6 months subsidiary's income statement. What will be the name in assets held for sale? Usually we gave them name disposal group held for sale. Usually the name would be disposal group held for sale. Disposal group held for sale. Same name with the liabilities, same name for the assets. Disposal group held for sale. Is that okay, guys? So this is discontinued operation part. It can be asked anytime. It is very frequently asked topic in SBR, guys. IFRS 5 is a very frequently asked topic in IFRS, in SBR. Now, what is next? Now, the concern here is we need to talk about assets held for sale and discontinued operation. Now, the concern is discontinued operation. We have talked about discontinued operation. Now, the concern is, now the topic is assets held for sale. If we have a non-current asset and we have a non-current asset, we have non-current asset, and usually our expectation about non-current assets, usually our intention about non-current asset is that we will get so non-current assets, usually the intention is that we will use these assets for another 2 to 3 years, 4 years, 5 years. But somehow the management has decided that these non-current assets should be sold soon. Means they have decided that non-current assets carrying value should be recovered through use rather than sale. through sale rather than use. What does it mean? It means you have intention to sell the asset. You have intention to sell the asset. So now the intention is to sell a non-current asset. So this is basically a definition of non-current asset. What is the definition of non-current asset? The definition of asset held for sale, non-current asset held for sale, is a non-current asset whose principal carrying value, principal means majority carrying value, will be recoverable through sale rather than use. It means now you have intention to sell that asset. We usually call it asset held for sale. We will present that asset held for sale as a current asset, because this is no more a non-current asset. You are going to sell it soon, so it means you are going to get benefit soon. So it should be reclassified from non-current assets to current assets. And if this has been presented as a current asset, so then you will not be charging any depreciation after classification. It means if this is the year that we are dealing, here the asset was non-current asset, but in middle of the year you have decided that we are going to sell this asset and it has been classified as held for sale. Now you will not be charging depreciation after this classification. When the asset has been classified as held for sale, then you will stop the depreciation, because no current asset will be depreciated. We don't charge depreciation on current assets, so no current assets will be depreciated. But yes, in these 6 months, we will be charging depreciation because it was non-current assets. So this will happen during the year. If assets are classified as held for sale, we will be charging depreciation before classification, and after classification, we will stop the depreciation. Now, if you want to classify asset as held for sale, there is a criteria. It must meet a criteria. If the criteria has met, then you can classify asset as held for sale, otherwise no. What is the criteria? This is the criteria that asset should be immediately available for sale in its present condition. What does it mean? It means there should be no delay from seller. If you are going to sell a car and you are saying that after repairs we will sell it, it means this is not immediately available for sale. It will be available for sale after repairs. If you are going to sell a building and you are saying that we will paint the building, we will renovate the building, and then we will sell this building, it means this building is not immediately available for sale. It will be available for sale in its current condition when the renovation and the repair work or the paint work has completed. Now, then sale should be highly probable. Sale is expected within 12 months. Program to locate buyer has started, means you have started to look. A buyer has started. You have started to advertise. You have started to look for a expected or potential buyer. So management is committed to sell, and it is unlikely that the decision will change. Demand price is reasonable in relation to market value. If you are asking too much, you are asking more than market value, obviously your asset will not be sold. So they are saying that the demand price should be reasonable if you really want to sell the asset. So if all the criteria are met, then we will say this asset is a asset held for sale. Now, if the asset is held for sale, what we need to do, we will initially record this asset held for sale at lower of carrying value. But this carrying value should be adjusted. This carrying value should be adjusted as per previous standard for depreciation until the date of classification. For revaluation, if asset is under revaluation model, then if asset is under revaluation, and for impairment. Impairment, obviously, IS 36 impairment. So you need to apply these 3 steps on the carrying value of asset before classification. If you want to classify, then you need to adjust the carrying value. First, you need to adjust the carrying value. So we will take carrying value, but the adjusted one. And then The B part is you need to take net selling price. Fair value less cost to sell. You will take net selling price or you will take fair value less cost to sell. Now, what is next? So you need to recognize at lower of. Now we need to make such certain journal entries and we will understand this concept and then we will be solving the question. So guys, the example is we have a carrying value of a plant. We have carrying value of plant at 1st Jan 2020. And what is the carrying value? The carrying value is 300 million. Now, so we need to take what we need to do. Now, the depreciation, annual depreciation is given. Annual depreciation is 30. At 1st Jan, at 31st March, 2022, criteria for held for sale met. Criteria for held for sale met. We have fair value here at 31st March. We have cost to sell. And we have recoverable value as well. Okay, we don't have recoverable value, we have value in use. Yes, discontinued operation. Yes, we need to do the same principle over discontinued operations assets as well. So we have this information. So fair value is 260. Cost to sell is 5%. And value in use is 230. So this is the data, guys. And they're asking you to present this, do accounting here. So do relevant accounting. And the year end is 31st December 2020. This is the year. So let's understand how we are going to solve this. The asset is held under revaluation model. Under revaluation model. So guys, now what we need to do. So when we need to classify this asset as held for sale, what should be the journal entry? What should be the double entry to record this? What should be the journal entry? We need to book held for sale asset at lower of. And we need to credit non-current asset with its adjusted carrying value. With adjusted carrying value. Now, asset held for sale asset, then we need to credit adjusted carrying value. And if there is any balancing amount, that balancing amount will be impairment loss. This will be a balancing amount. Okay. Now what to do, guys? First, you need to adjust the carrying value as per relevant standard, as per previous standard. So the first step should be adjust the carrying value as per previous standard. If we have a plant, the previous standard is IS 16, so we need to adjust. So what is the carrying value, guys? Carrying value at 1st Jan. Carrying value at 1st Jan is carrying value held first is carrying value is 300, guys. We need to depreciate this. We need to make 3 adjustments, guys. The first one is depreciation. So we need to depreciate. How much depreciation, guys? Annual depreciation is given, which is 30, but we don't need annual depreciation because the criteria has met after 3 months, 31st March 2020. So 3 months depreciation is required. So we need to charge 3 months depreciation. Make it okay, 3 months. Please give me 3 months depreciation. What is 3 months depreciation? Okay, someone asked me if the model is revaluation model, why we are charging depreciation? We do charge depreciation or under revaluation model. But if it is under IS 40, there was investment property, then under investment property, there is a model, fair value model. In that model, we don't charge depreciation. But in IS 16, plants, revaluation model, we do charge depreciation. So we have a depreciation 7.5. Now we have adjusted our carrying value with depreciation and the amount is 292.5. Now you need to revalue, guys. The second step is you need to revalue. So the revalue would be only with market value or fair value. So fair value is given, 260 is the fair value. So you need to revalue. So we have a revaluation gain, guys. So we have revaluation gain. What is the value of revaluation gain? No, we don't have revaluation gain. We have revaluation loss. The market value is less than the carrying value. So we have revaluation loss, guys. What is the revaluation loss? The asset market value is 260, but the asset carrying value is, so we have loss of 32.5. This is our loss. Now we have done with the revaluation. This revaluation loss will be charged to P&L if there is no previous gain. If there are certain gains, obviously this loss will offset the previous gains. Now you need to apply an impairment. So the steps are, you need to depreciate. If not depreciated till held for sale date, till the classification date. The second step would be revalue. And the third step is you need to apply an impairment test. Now, what is recoverable value, guys? We know impairment test as per IS 36. In impairment test as per IS 36, we have recoverable value. What would be the recoverable value, guys? Please do let me know what would be the recoverable value. Recoverable value would be higher of value in use and fair value less cost to sell. So please do let me know what is the value in use. Value in use given is 230. But what is the fair value less cost to sell? What is the fair value less cost to sell? Please do let me know what is the fair value less cost to sell. We have fair value 260. 260 minus, we need to deduct 5% selling cost. We need to deduct selling cost. So we can take 95% of this value to deduct 5%. So the fair value less cost to sell is, what is the fair value less cost to sell, guys? $247. Thank you so much. So now the recoverable value is 247. So we have another impairment loss. we have impairment loss of how much, guys? As per IS 36, we have impairment loss of 13. Basically, this 13 is loss due to cost to sell. Now, guys, you need to apply an impairment test. Asset held for sale, adjusted carrying value will be at the here. So 247 is the carrying value, adjusted carrying value. Now you need to write assets at lower of fair value less cost to sell and adjusted carrying value. And interestingly, both values are same. We have adjusted carrying value 247 and we have fair value less cost to sell is 247. So both values are same. Then you can pick any value. So this is 247, no impairment loss. So this is how you are going to initially classify assets held for sale. Is that okay, guys? Now we are moving towards the question. We will solve a question, and then after that question, we will be discussing a little more about IFRS 5, and then we need to revise sale and leaseback transactions. So I will share these noted slides, handwritten slides with you guys. So let's see, guys. This is the question that we are going to solve. So in May 2006, again a question from BPP exam kit, basically a past paper question. In May 2003, and what is our year end? Listen carefully. Our year end is 30th November X3. Okay. So our year end is 30th November X3. In May 2003, H decided to sell one of its regional business division through a mixed assets and share deal. The decision to sell the division at a price of 40 million was made public in November 2003. So in November, you have made it clear that we want to sell this at 40. And gained shareholders' approval in December 2003, it was decided that the payment of any agreed sale price could be deferred until 30th November X5. It is estimated that the cost of allowing the deferred payment is 0.5 and that legal and other professional fee associated with the disposal will be around 1 million. So what would be the cost to sell, guys? What would be the cost to sell? What do you think, guys? What would be the cost to sell? 1.5? Yes. So 0.5 and 1. It means we have cost to sell 1 million. The business division was identified correctly as held for sale. This is the important thing. Look, the examiner is saying in the question that they have correctly identified this as a held for sale. So you don't need to write it held for sale criteria because the criteria has already been met. You don't need to comment on this thing whether it is correct or not. He's saying correctly as held for sale. So there is no debate at all. If they are saying that they have treated it as held for sale, then we can debate that whether it should be classified as held for sale or not. But if they are saying that they have correctly identified it as held for sale, then there is no debate at all. Well, and you don't need to write anything about that. Presented as a disposal group, and look, presented as disposal group means there are more than one assets in the statement of financial position as at 30th November 2003. At the initial classification of division, initial classification means initial measurement, as held for sale, its net carrying amount was 90 million. So what was the carrying value, guys? 90 million. In writing down the disposal group carrying value was 90. In writing down the disposal group's carrying amount, H accounted for impairment loss of 30. So they are saying that the impairment loss is 30. So you don't need to calculate impairment loss. They are giving you impairment loss. In my example, I was calculating impairment loss, guys. I was comparing this with recoverable value. The carrying value was 260. I was booking impairment loss. But what the examiner is doing with you guys in this question is giving you impairment loss. You just need to deduct, and that's it. which represents the difference between the carrying amount and the value of assets measured in accordance with applicable IFRS. So what we need to do, guys, just do let me know. So you need to explain the initial measurement that we will recognize the assets at lower of asset fair value less cost to sell and adjusted carrying value. So we need to adjust. There is no need to charge depreciation here because the depreciation is not there. Now what we need to do is listen carefully. So guys, just tell me how we can adjust the carrying value. What is the carrying value? Carrying value is given, guys. We are demanding 40 million. This would be a market value, the demand price. But I'm here just for to calculate adjusted carrying value. So what is the adjusted carrying value, guys? Adjusted carrying value is the value was 90 million. If there is an impairment loss of 30, so we need to book an impairment loss. This will give us adjusted carrying value of 60. So 60 million is the adjusted carrying value. Is that okay? And you have to tell them that you have to write that initially you need to adjust the carrying value of assets held for sale as per the previous standards. So what is next now? What is next now? So we have adjusted carrying values. So what is next now, guys? Now you have to take fair value less cost to sell and you have to make a journal entry. Fair value less cost to sell. So what is the fair value less cost to sell, guys? Fair value less cost to sell. 40 is the expected price and cost to sell is 1.5. So the total amount fair value less cost to sell is 38.5. Now you have to make a journal entry and you will explain this. The journal entry would be disposal group held for sale. Now it is a group of assets. So disposal group held for sale. You need to credit assets carrying value. So the carrying value of assets was 60. Held for sale value should be lower of. It should be lower of. It should be lower of. Whichever is lower, guys, 38.5. And you need to recognize an impairment loss. How much impairment loss? Obviously, the balancing one. So what is the additional impairment loss that you need to book is 21.5. This is impairment loss as per IFRS 5 and it should be charged to profit and loss. So guys, this is something that you need to write. You have to explain all the process in theory, and you have to, if you want to give the journal entry, it's okay. If you don't want to write this entry and you just need to explain this, and even then it would be considered a good answer. So there is no need to write journal entries if it is not asking. Is that okay, guys? Please do let me know. Now, the next thing that is in the next part of the question, that is sale and leaseback transaction. So here is the sale and leaseback transaction question. So this is part C of this question. So let's see what is the requirement. Explain to the directors. They are saying explain. So you have to explain to the directors how to account for the sale of the main office building at the start of the lease, including any gain on the sale. So you have to tell them how to treat this, and you have to book any gain or loss. So second requirement is, basically third requirement is, comment on the effect of transaction, effect of this transactions, or effect of this transaction, age interest cover ratio. So what is the interest cover ratio, guys? It is profit before interest and tax divided by interest expense. So this is the interest cover ratio. So this is how the examiner is going to ask about different ratios, guys. So let's understand, we need to revise. Obviously, we need to revise, and then we will be talking about. Guys, please do let me know if you need a revision, then I will revise. Otherwise, I'm quickly going to solve this question. Do you need a revision of sale and leaseback transaction, or it's okay? I can quickly solve the question. Okay. So everyone is saying, please revise. Thank you, everyone. So I need to revise now. So sale and leaseback transaction, guys, which is very simple transaction. So what is this transaction, sale and leasebacks? Listen carefully. You have an asset. You have your asset. Just suppose you have a car. And what you are doing, you have a car. And what you are doing, you need a cash. You have a car and you need a cash. So you try to take a loan. No one is willing to give you a loan. So nothing is working for you. So what you did, you sold your car. So you have sold your car. So first what we did, we sold our car. So car is sold. We have sold our car, received cash and received cash. Now actually we need this car. So here is Mr. A. We are doing this transaction with Mr. A. Now what Mr. A is doing, now we asked Mr. A, please give this car back to us on lease. So the same car, this is same car, this is not different car, guys. If the car is different, then obviously this is not sale and lease back transaction. Just listen carefully, sale and lease back. Sale, you are selling your asset and the same asset is being leased back from the party that is actually buying the asset. So you leased it back. So we leased it back. Now the purpose was that now again we are using this asset as a lessee. Still the car is with us, but as a lessee. Previously the car was owned car. Owned car means the car was in our ownership. Now we have sold this to Mr. A. Ownership belongs to Mr. A, but we leased it back from Mr. A. Now we are the lessee of this car. So we usually call ourselves as a seller because we are selling, and then we are leasing it back. We call it seller and lessee. So it is the same party, seller and lessee. First we sold the car and then we lease it back as a lessee. So we are the seller and we are the lessee. Now what we need to do, so as per IFRS 16, what we need to do in sale and lease back transaction. So this is important. Now they are saying identify whether this is a sale or not. Identify this is a sale or not. This is a sale or not. So what they are saying, identify this is a sale or not. You need to identify whether it's a sale or not. Now, which standard will help us to identify whether it's a sale or not? Obviously, IFRS 15. IFRS 15. And IFRS 15 says, if control lost, if you have lost the control, if control of asset, control of car transferred to other party, then it's a sale. It's a sale. If control still retained by us, if control not transferred, no sale. Now the treatment would be different in both situations. So listen carefully. If control not transferred, no sale. If control transferred, it's a sale. Now, what are the indications? Let me write some indications. Sir, if indication, if remaining life of asset is equal to lease term. If remaining life of asset is equal to lease term, means the remaining life of the car was 5 years and we have leased it back for 5 years. If the remaining asset's life was 50 years and we have leased it back for 50 years, it means previously we were using it for 5 years, we were using it for 50 years, and still after the lease and sale back transaction, we will be using it for 50 and 5 years. It means the whole life previously, before the sale, we are going to use this asset for remaining life. And even after the sale and lease back, because the lease term and remaining life is same, so we are going to use this asset for the whole period. So this means this is not a sale. But if there is a difference, then obviously it is a sale. Now, if it is not a sale, then how we are going to treat this transaction? So listen carefully. Listen carefully. So listen carefully. So say if you are not selling a car and you are taking cash from someone, you're not disposing your asset, you're not selling your asset, then it means it's a loan transaction. So it is a loan transaction. It is a loan transaction. Means you have put your car as a security, you have given the car as a security to them, and you have acquired a loan. So what should be the journal entry and what should be the accounting treatment? So what is the accounting treatment? Accounting treatment is, what should be the accounting? The accounting is continue to recognize the car in your books. We can say do not de-recognize the car. Do not de-recognize the car. Why we are not de-recognizing the car? Because we are not selling the car. Do not de-recognize the car. Car in my example, do not de-recognize the asset. Then, and any cash received is a loan. So any cash received is the loan. And obviously loan will be, there will be an interest on loan. So any cash received is a loan. And loan will be dealt under IFRS 9. Any cash received is equal to loan, and loan, we know we have to make an effective interest rate table, opening balance, then finance cost, then interest paid and closing balance. In other words, you can say we need to book an interest on the loan as well. So this is if the control not transferred. But if control transferred, then what we need to do? If we have transferred the control, then what we need to do? If we have transferred the control, then what we need to do? Okay, guys. Then it is a sale. It is a sale. They are saying okay, I'll explain in a while. So now what is next, guys? So listen carefully. Now I'm going to explain. Yes, very true. You have to de-recognize. Yes, you have to de-recognize. But what they say, yes, you have to de-recognize. You are right, but you again need to recognize it as a lessee as well. Okay, first I have to give an entry, then I'll explain it. Okay, guys, you have to de-recognize the asset. So you are going to credit assets carrying value. You are going to credit asset carrying value. So this is credit asset carrying value. And any cash received is the disposal proceeds, means you have received some cash and the cash will be on the debit side. Guys, what is the disposal entry? We need to credit asset carrying value. We are actually de-recognizing the asset. We are recording the cash that we are receiving from selling this car. And then look, so cash, we are receiving cash, debit is cash, we are giving them car and we are selling this car. So we need to decrease this assets car carrying value. We need to de-recognize the carrying value. This is disposal entry. Now make a lessee entry. What should be the lessee entry? We have leased it back. So what is the accounting of lessee, guys? Do apply the lessee accounting. So it is the genuine sale. If we are selling, then it means we are leasing back. We have sold and now we are leasing it back. So what is the recording? What is the journal entry to record asset acquired under lease? Yes, you are right. You have to book a right of use asset and you have to book a lease liability. Look, this is what you need to do. So you have passed a disposal entry and then you have passed asset acquired under lease. And obviously in a disposal entry, you will have profit or loss. So loss or profit will be a balancing amount. If it is on debit side, it will be a balancing amount. On the debit side, it will be a loss. And it is if it is on credit side, it will be a profit. So this is what you need to do. Okay, so what we need to do, the last thing that we need to know about this is that this right of use asset, you need to apply a formula on this right of use asset. And what is that formula? You have to take carrying value and you need to multiply it with lease liability and you need to divide it with fair value of asset. So this is what you are going to do. Now we need to apply this concept to the question so that the question, we can complete the question, and then I'm going to give you more examples regarding this. Okay, so let's move towards the question, guys. So this is what actually is being tested in this example. Okay, in this question. So this is the question, guys. So let's understand. H has decided to sell its main office building to a third party for 5 million. And leased it back for 10 years lease. So and leased it back for 10 years. The current fair value of the property is 5 million. So we are selling at market value. This would be an important. And the carrying amount of asset is 4.2. So we have a carrying value as well. The present value of lease payment has been calculated as 3.85 million. The liability is also given. The remaining useful life of the building is 15 years. So someone asked me that he didn't get the remaining life part. So listen carefully, please. Look, the total benefit of the asset is 15 years. It means asset can give you a benefit of 15 years. Now, you are taking it back for 10 years. It means, what does it mean? It means asset was a benefit of 15 years. You are selling 15 years, and then you are taking back only 10 years. You are only taking back 10 years. You are taking back 10 for 10 years. Look, we can clearly witness that before this transaction, the asset was to give me a benefit for 15 years. But after this transaction, I will only get benefit of 10 years. So we can clearly witness that we have sold some portion of this asset, like 15 years was the total benefit. I have transferred 15 years, and then I again acquired for 10 years. So it means I can say that we have disposed the asset, although it's a partial disposal. So we call it as a partial disposal and partial retention. That yes, there is a disposal, but partial disposal. And we have partially retained this asset. So there is a partial retention. So you have to mention this thing as well. So we call it partial retention because we are partly keeping this asset with us, and we are selling some portion of this asset. But what will happen if this asset is being leased back for 15 years? Just do let me know. We have disposed 15 years of benefit to someone, and then we reacquired it again immediately for 15 years. Can you say that this is the disposal if both lease term and the useful life is for 15 years? Okay. Now, guys, I hope everyone is clear. So, if this will be same, it is not a sale. If this is different, then obviously it is a sale. Now here, if this is different, so it will be a considered sale. But the examiner is saying the transaction constitute a sale in accordance with IFRS 15. He's saying it is a sale. HCOs believe that this represents a very good deal for H and not has told you that a profit on disposal is 0.8 million. He's saying that profit is 8 million. This is the total profit. Like carrying value was 4.2, fair value was 5 million. So this is total disposal, but we cannot book a total profit loss on disposal. We need to book a partial disposal. Okay, will help to ensure that the company meets the covenants imposed by the bank in respect of H interest cover ratio. Look, the intention is to not to breach the covenants related to interest cover. H board of directors would like information about the fact of the introduction of IFRS 16 leases, particularly the bank covenants, and this was just a general information. Actually, there was one part that I didn't pick, and that was what are the impact of IFRS 16 changes. There was a first part of the question requirement. What was the impact that I didn't pick as a part of question. Now, guys, what is interesting? So we need to make a journal entry. So look, you will debit cash, and you are going to credit asset carrying value. You just need to post the values, guys. That's it. Look. Then you are leasing it back. So we are going to debit right of use asset, and we are going to credit lease liability. And the balancing amount will be profit loss. So put the values, guys. So we are going to sell it at for 5. It means the cash received would be 5. Okay. They are saying the carrying value is 4.2. So the carrying value is 4.2. We are going to de-recognize 4.2. They are saying the lease liability is 3.85. So the liability is 3.85. Now we need to calculate right of use asset. The formula is very simple. 4.2. Out of this carrying value, we are saying out of this carrying value, we retain some portion, and the retained portion is lease liability, which is 3.85. This is retained portion, and we need to divide it with fair value. What is the fair value of asset? 5. So we will get right of use asset. So we need to keep the carrying value related to retained portion. This is related to retained portion. So what will be the value, guys? I need an answer, guys. What would be the value? It is 3.23. Okay, fair enough. It is 3.23. Okay. So this is 3.234. So guys, now we need a balancing amount. Here we have 8.234. Here we have 4 maybe 15. Yes, 4.05. 7.05. So the debit side is more. So we need to book a profit. So what would be the profit, guys? Profit would be the balancing amount. Please give me what is the profit? 0.184. 0.184, guys. So this is how you are going to do, but you need to mention them that we will consider it as a partial disposal, partial retention. We are going to book profit or loss related to disposed portion. Profit or loss on disposed portion will be recognized. On the other hand, partial retention means carrying value will be retained. So carrying value related to retained portion will be booked in the asset. So this is carrying value retained related to retained portion, and this is profit or loss related to disposal portion. Now, guys, this was the question. So what is the impact on interest cover ratio? Please do let me know what would be the impact of this ratio or this treatment on interest cover. Now, after this, what you need to do, you need to depreciate this asset over lease term, which is 10 years. And you have to increase this liability with finance cost, with interest, it will keep increasing and it will decrease by lease payments. So we know the subsequent treatment. So what would be the impact of this transaction on interest cover ratio? Please do let me know. What would be the impact, guys? Sir, you need to book this profit in P&L right now. It will increase your profits. And obviously, the formula is profit before interest and tax divided by interest cover. And obviously, this ratio will increase a little bit. But we don't have any information on interest expense, so we don't know what is the exact impact. But we can say that by increasing the profit before interest and tax by 0.184, obviously the interest cover ratio will increase, which is a good sign. Now, guys, now I'm going to repeat this same transaction. If the asset is not being sold at fair value, if the asset is being not sold at fair value, this is the asset at fair value. So what would be the formula if sold at less than fair value? If sold at less than fair value. So formula if sold, okay, if sold at less than fair value. It's sold at less than fair value. Then what we are going to do? So formula would be same. We will take carrying value. We are going to multiply this with lease liability divided by fair value. But because we are selling less than fair value, that less amount, the difference between fair value and selling price, would be considered as a prepayment, and we are going to adjust that prepayment here. So the less amount, the loss is equal to the less amount is prepayment. Prepayment means just like initial deposit. If sold above fair value, then extra amount is loan. Extra finance, extra loan, extra amount is loan. Then the formula would be carrying value multiplied by lease liability. And in this lease liability, we have some extra loan. So we need to deduct this amount, loan amount, and divide it by, again, fair value. What does it mean, sir? So let me give you a quick example. So listen carefully. So assets carrying value is 500. Lease liability is 300. Fair value is 600, guys. Look. Now in this situation, sold for. Okay, I'm selling it for 570. Sir, how much less I'm receiving? How much is the loss at the time of sale? How much less I'm receiving? 30. Yes, 30 is prepayment. 30 is prepayment. Now, so what should be the journal entry now? We need to debit cash. We need to debit right of use asset. We need to credit lease liability. We need to credit asset carrying value. So the carrying value would be, guys, what is the carrying value? 500. What is the lease liability? This is given 300. Cash is cash. We have sold it for 570. So cash is 570, guys. Now what is the formula? So apply the formula. Formula is, you need to take carrying value, which is 500. You need to multiply this with the, how much? Lease liability, which is 300, divided by fair value divided by fair value, which is 600. Some people do it in this way, like they add it here. You can do that this as well. Some people add it here. So both approaches are okay. Some add it here, some add it first. They apply the formula, same formula, and they add it afterwards. So it's totally up to you. What do you want to do? So look, what is the value of this exactly? I think it would be exactly 280. If I'm going to apply this formula this way, it would be 280. So what is the profit, guys? What is the profit? 280 plus 570 less lease liability less carrying value. What is the profit, guys? Please. 50. So this is profit, guys. 50. No, it should not be 50, guys. Is it 50? Okay, fair enough. Now, what is the next? If it is sold for if it is sold for, if it is sold for $640, now what is the extra amount that we are receiving is 40. So extra 40 above fair value, we are selling above fair value. Extra 40 is the loan amount. So what we need to do is debit would be cash. So the cash would be, so I'm writing the same, using the same debit credit 640. So here debit would be 640 now because we are selling the 640. Lease liability will be same 300. The question is same. Carrying value, it would be same 500. Carrying value would be same 500. Now we need to calculate this. We need to apply the formula, same formula, but a little bit change. 500 multiplied by lease liability, which is 300. We need to deduct 40 loan out from this, and we will divide it by 600. So what is the formula, guys? It is actually 260 divided by 600, guys. What would be the carrying value? Please do let me know. What would be the carrying value? Two 217? Yes, we round it off, guys. This is 217. Okay, so balancing amount is, this is 614, this is exactly 857, and this is 800. So the profit amount is 57, guys. This is balancing. I hope everyone is clear, guys. I'm going to share these slides with you guys. That's it for today, guys. Thank you so much. It was really an honor to have you for this in this practice to pass session. See you in the WhatsApp group. If you have any problem, we will stay connected in WhatsApp group. My number is, if you have any issues, my number is, this is my number. If you are unable to join WhatsApp group, just drop a text, just drop a WhatsApp on this number. I will share a link. Thank you so much, guys. Keep fine. You have plenty of time. Honestly speaking, the paper is on 9th of June, and you have plenty of time. If you are going to pass, if you just want to pass the exam, just try to focus and just give some time to the studies, and still you have plenty of time and you can easily go through. Stay blessed. Allah Hafiz.